Beneath Manhattan, inside a vault so secret most financiers don't know it exists, lies the paper ghost of your entire portfolio. Think the stock you just bought is real? You've likely never touched it. When you tap Buy in your app, what you receive is a digital promise from a name on almost every physical stock certificate. Seed & Co. For 4 centuries, markets ran on paper logic. In 1973, we locked that paper away to make digital trades fly. But true ownership never escaped that building. On December 11, 2025, the CC quietly signed a death warrant for that old world. They issued a no-action letter, and with that single document, opened the gates to an entirely new paradigm of ownership. The Depository Trust and Clearing Corporation, the DTCC, the hidden plumbing of every U.S. market trade, now has a hard deadline, the second half of 2026. This is when the new system goes live. We are shifting from an era of guarded paper to one of open digital gateways. Today, I'll outline the exact strategic moves I'm planning to make before this $100 trillion transfer of wealth is finalized. My focus isn't on volatile cryptocurrencies, but on the established pillars constructing this new financial bedrock. Why would the most powerful banks on earth build a revolutionary system just to watch it burn? The answer is simple. They never act without a guaranteed exit. This is a two-way bridge. Institutions won't just toss a stock onto the internet. The physical asset stays secured at the DTCC as the ultimate anchor. The digital token? That's merely a high-velocity trading vehicle. Think of it as a high-fidelity digital twin inside a cutting-edge flight simulator. On the blockchain simulator, you can execute complex maneuvers at impossible speeds, trading in an instant with zero physical drag. But the simulation is never fake. It's hardwired to a real multi-million-dollar aircraft parked safely in the hangar. Just like the real stock sits in that vault. When the digital mission ends, you erase the simulation. The digital jet vanishes, but the real one remains, ready for the next pilot. Tokenization doesn't replace the asset. It lets us operate at velocities the physical world could never permit. So, what's the urgent need for this complexity? You must examine the staggering amount of capital currently locked in limbo by today's system. Right now, clearinghouses stand between every buyer and seller as a central guarantor. If one party fails, they ensure the trade completes. To manage this risk, banks must park billions in collateral dead money, sitting idle for days, just in case of a default. It's a massive systemic inefficiency. Now, imagine a different path. If that asset is a token on a blockchain, it settles atomically. In simple terms, the payment and the asset transfer occur simultaneously, in an instant. This erases the risky settlement gap. It means an asset could generate yield by the second, not the quarter. It could be used as loan collateral at 3 a.m. on a Sunday. It transforms from a static certificate into dynamic, living code that works for you every moment of every day. Here's the market impact. Capital efficiency is about to explode. If BlackRock can move $2 billion in tokenized treasuries instantly, instead of waiting 3 days, they're not doing it for novelty. They're unlocking billions in once-trapped capital. The World Economic Forum projects tens of billions in annual savings, just from eliminating manual paperwork that is the entire profit margin for some banks. Tokenization turns trapped capital into kinetic energy. You might wonder, how does the exit back to the old world work? A major bank needs to move a stock back into a legacy account. They execute a burn. The digital token is permanently deleted from the blockchain, gone forever. That deletion triggers an automated command to the vault. The digital twin is dead. Release the original paper entitlement. It's seamless. But the initial tidal wave of money isn't rushing into digital stocks. Not yet. It's flooding into the $10 trillion market of alternative assets. Private equity, real estate, and institutional credit, once bogged down by weeks of paperwork, are now flowing onto digital rails. And data shows over 65% of all tokenized real-world assets are currently settling on one dominant backbone. Wall Street's innovation on the blockchain will unfold over the next decade, covering everything from equities to intellectual property. JP Morgan isn't waiting. Their Onyx network is already processing billions daily. They're not experimenting. They're using it to run their global treasury. Even corporate giants like MicroStrategy are making historic bets, aiming to corner a significant portion of the total Ethereum supply for their balance sheet. But a critical warning is necessary. While Ethereum is the current backbone, it's not a guaranteed winner. We're in an infrastructure war. Institutions crave the speed of code, but demand total control. JP Morgan built on a permissioned private version. Goldman Sachs is spinning out its own platform, GSDApp, because they want proprietary rails, not shared ones. This is the battle for the next half-century of finance. So, with the world's largest banks moving billions and corporate treasuries accumulating aggressively, how do we position ourselves? The reality is, institutions have had a multi-year head start. Their building began years ago. By the time mainstream media headlines scream, tokenization, the easiest gains will have been captured. The 2026 deadline is our window to shift from institutional testing to full public rollout. Here's how I'm structuring my capital for the 2026 transition, using a 70-20-10 allocation focused on asymmetry. First, the 70% core, the infrastructure controllers. This is the institutional bet. JP Morgan is the pioneer. Goldman Sachs is turning its platform into a fee-generating software business. Supporting players include Nasdaq, selling tokenization tech to other exchanges, and custodians like BNY Mellon building the digital vaults. These aren't moonshots. They're the toll collectors of the new system, with lower protocol risk. Second, the 20% pure play, the essential toll booth. Think of a company like Securitize. They are the behind-the-scenes engine that tokenizes real-world assets for giants like BlackRock. They handle the legal and technical plumbing as an SEC-registered entity. They power a significant portion of the entire tokenized asset market. If tokenization scales to multi-trillions, this company collects a fee on a massive volume of transactions. It's my highest conviction pure play. Don't just use the new rails on the toll booth. Finally, the 10% speculative edge, the public protocol. Ethereum currently hosts most tokenized assets. Some analysts project dramatic price targets for 2026. A more aggressive, leveraged bet within this slice could be a corporate treasury aggressively accumulating Ethereum. This is for those betting decisively on Ethereum becoming the dominant global settlement layer. This allocation matches my conviction. Institutions will control tokenization. The banks and infrastructure providers win in most scenarios. The pure play wins as volume explodes. The protocol only wins under specific dominant outcomes. It's the least certain. I have one non-negotiable rule. Price exposure is not legal ownership. In 2026, I will avoid any tokenized stock that doesn't provide a direct, verifiable legal claim to the asset in that vault. If I can't trace it back, I won't touch it. The global financial system is being rewritten in real time. You can either be a user of this new code, paying the fees, or an owner of the infrastructure collecting them. Most will hear about this in 2027 when it's priced in. You're hearing it now, with time to research and build positions before the crowd arrives. This is a freight train that can't be stopped. If this breakdown helped you see the tracks ahead, please like this video. It directly supports this channel, Winds of Thought, and helps others find this crucial information. The difference between early and late in an infrastructure shift isn't 20%. It's the difference between getting in at the ground floor and buying at the penthouse. You have time. Do your homework. And remember, this is for educational purposes. I'm not a financial advisor, and all investments carry risk. Thank you for watching Winds of Thought.